Hello everyone and welcome to today's video where we'll be discussing whether or not it's a good time to invest in real estate. Real estate is an important asset class that has historically provided investors with a number of benefits, including cash flow, appreciation, and tax advantages. However, the real estate market can be highly cyclical and can fluctuate greatly based on a variety of factors, including economic conditions, interest rates, and demographic trends. In this video, we'll explore some of these factors and try to answer the question of whether or not it's a good time to invest in real estate. 1. Current economic conditions. The first factor we'll consider when determining whether or not it's a good time to invest in real estate is the current state of the economy. In general, a strong economy tends to be good for real estate, as it creates more demand for housing and commercial space. Conversely, a weak economy can lead to a downturn in the real estate market, as people have less money to spend on housing and businesses are less likely to expand or relocate. Currently, the United States is experiencing a period of economic growth, with low unemployment rates and steady GDP growth. This suggests that it could be a good time to invest in real estate, as there is likely to be strong demand for both residential and commercial properties. However, it's important to note that economic conditions can change quickly, and it's always a good idea to be cautious when investing in real estate. 2. Interest rates. The second factor we'll consider is interest rates. Interest rates can have a major impact on the real estate market, as they affect the cost of borrowing money to purchase properties. When interest rates are low, it's generally easier and cheaper to obtain financing for real estate investments, which can lead to increased demand for properties and higher prices. Conversely, when interest rates are high, borrowing money to invest in real estate becomes more expensive, which can lead to lower demand and lower prices. Currently, interest rates in the United States are at historic lows, which could be good news for real estate investors. Low interest rates make it easier and more affordable to finance real estate purchases, which can lead to increased demand and higher prices. However, as with economic conditions, interest rates can change quickly, and it's important to keep an eye on them when considering investing in real estate. 3. Demographic trends. The third factor we'll consider is demographic trends. Demographic trends can have a major impact on the real estate market, as they affect the demand for different types of properties. For example, as the baby boomer generation ages, there may be increased demand for senior living communities and assisted living facilities. Similarly, as younger generations enter the workforce and start families, there may be increased demand for single-family homes and larger apartments. Currently, there are a number of demographic trends that could be good news for real estate investors. For example, millennials are starting to enter their prime home buying years, which could lead to increased demand for starter homes and entry-level apartments. Additionally, as the population ages, there may be increased demand for senior living facilities and other types of age-restricted housing. 4. Risks to consider. While there are certainly reasons to be optimistic about investing in real estate, it's important to be aware of the risks involved. Real estate investments can be highly illiquid, meaning that it can be difficult to sell a property quickly if you need to raise cash. Additionally, real estate investments can be subject to a variety of expenses, including property taxes, maintenance costs, and insurance. Another potential risk to consider is the possibility of a market downturn. While economic conditions are currently favorable for real estate investment, this could change quickly. A market downturn could lead to decreased demand for properties, which could in turn lead to lower prices and decreased cash flow for investors. Additionally, rising interest rates could make it more difficult and expensive to finance real estate investments. It's also important to consider the specific risks associated with different types of real estate investments. For example, investing in commercial properties can be riskier than investing in residential properties, as commercial properties are more sensitive to economic conditions and changes in demand. Similarly, investing in rental properties can be riskier than investing in properties that are owner-occupied, as landlords may face difficulties with tenants, rent collection, and maintenance. 5. Strategies for investing in real estate. Now that we've explored some of the factors to consider when deciding whether or not to invest in real estate, let's take a look at some strategies for investing in this asset class. One popular strategy for investing in real estate is to purchase rental properties. This involves buying a property and renting it out to tenants with the goal of generating cash flow from rental income. This can be a good strategy for investors who are looking for steady, long-term returns, but it requires careful management of the property and the tenants. Another strategy is to invest in real estate investment trusts. REITs are companies that own and manage real estate properties, and they offer investors the opportunity to invest in real estate without actually owning a physical property. REITs can provide investors with steady cash flow and diversification, but they can also be subject to market volatility and management risk. A third strategy is to invest in real estate crowdfunding platforms. Crowdfunding platforms allow investors to pool their money together to invest in a specific real estate project or portfolio of properties. This can be a good way to invest in real estate with lower capital requirements and greater diversification, but it can also be subject to liquidity and management risk. 6. How to finance your real estate investment. One of the biggest challenges of real estate investing is financing your investment. Here are some financing options to consider. Traditional mortgages. You can get a traditional mortgage from a bank or lender to finance your real estate investment. This option may require a larger down payment and can have stricter lending requirements, but it offers lower interest rates and longer repayment terms. Private lenders. Private lenders are individuals or companies that lend money to real estate investors. This option may have higher interest rates and shorter repayment terms, but it can be a good option for investors who have trouble getting approved for traditional mortgages. Hard money loans. Hard money loans are short-term loans that are typically used for fix and flip properties or other types of real estate investments that require quick financing. These loans have higher interest rates and fees, but they can be a good option for investors who need funding quickly. Cash. If you have enough cash on hand, you can use it to finance your real estate investment. This option offers more flexibility and can help you avoid interest payments, but it requires a significant amount of capital. 7. Tax implications of real estate investing. Real estate investing can have significant tax implications. Here are some key tax considerations to keep in mind. Depreciation. Real estate investors can take advantage of depreciation deductions, which allow them to deduct a portion of the property's value over time. This can reduce taxable income and lower your overall tax bill. Capital gains tax. If you sell a property for more than you paid for it, you'll be subject to capital gains tax. However, you can minimize this tax by holding the property for more than a year, which qualifies for long-term capital gains tax rates, and using a 1031 exchange to defer the tax. Passive activity losses. If you have losses from your real estate investments, you may be able to deduct them against your other income, subject to certain limitations. This can reduce your taxable income and lower your tax bill. 8. Real estate investment. Strategies for beginners. If you're new to real estate investing, here are some strategies to consider. Start small. Consider investing in a single rental property or a small portfolio of properties to get started. This can help you gain experience and learn the ropes before moving on to larger investments. Do your research. Before investing in any property, do your due diligence and research the market, the property's history, and the potential risks and rewards. This can help you make informed decisions and avoid costly mistakes. Consider partnering with others. Partnering with other investors or a real estate professional can help you pool your resources and expertise and can reduce your risk. Conclusion. So, is it a good time to invest in real estate? The answer is, it depends. There are certainly reasons to be optimistic about real estate investing, including favorable economic conditions, low interest rates, and demographic trends. However, It's important to be aware of the risks involved, including market downturns, illiquidity, and management risk. Ultimately, the decision to invest in real estate should be based on your personal financial goals, risk tolerance, and investment strategy. Thank you for watching, and we hope you found this video helpful in making your investment decisions. If you found this video helpful, please give it a thumbs up and consider subscribing to our channel for more informative content like this. Your support helps us to create more valuable content and reach more viewers. Also, feel free to leave a comment below with any questions or feedback you may have. We appreciate your support and look forward to bringing you more great content in the future.